what I want to talk about next is something that will be brand new for the 2026 tax year, and that is an introduction to auto-enrolment. So auto-enrolment is Ireland's new retirement savings scheme, and it's there just to help employees build a pension pot through shared contributions. So this is going to come into place on the 1st of January 2026, and it'll run under the name My Future Fund. So employees will contribute a set percentage of their gross salary. Employers will match that contribution, and then the state will add a top-up. So the goal of this is just to make saving for retirement easier and more accessible, whilst it also simplifies the process for you as a business to offer a workplace pension. So the scheme will operate under the branding My Future Fund, and it'll be managed by NERSA, and that just stands for the National Automatic Enrolment Retirement Savings Authority. So what they'll do, they'll oversee enrolment, contributions, investment and communication. And just like any existing pension schemes, NERSA will be supervised by the Pensions Authority when everything launches in January. So let's talk about auto-enrolment and who actually qualifies. So to be auto-enrolled into My Future Fund, employees must be aged between 23 and 60. They have to earn over €20,000 annually and not already be in a pension scheme. Now, if they're outside of the age bracket or the earnings bracket, then they can still choose to opt in voluntarily if they want to, and they can do that through their employee online portal. Now, something I do want to note is if an employee has multiple jobs, it is their combined earnings that can actually make them eligible. So even if their earnings with you are below the €20,000, they can still be enrolled by any employer when they're not already in a pension scheme. So eligibility is based on earnings, so it doesn't factor in contract type or length, so if someone's a seasonal worker or part-time. So everyone will be considered, and it will be based on total earnings across all employments. So definitely something to bear in mind if you've got any employees with multiple jobs. So a little bit on how contributions will work. So contribution rates are fixed, and there's no changes allowed at all to these contribution amounts in these early years. So employees and employers will each pay the same amount. And then instead of tax relief, the state adds a top-up. So that just makes the scheme a little bit simpler and a bit easier for you to implement. So to ease the cost, contributions will gradually increase over the first 10 years of the scheme. So you can see on the slide there, they'll start at 1.5% for both employee and employer. And then they'll increase by 1.5% every 3 years. Now, by year 10, both employee and employer will pay 6%, and the state will be adding a 2% top-up. So you can see over time, contributions go from 3.5% to 14% over those 10 years. Now, something to bear in mind is if someone joins in year 8, they'll start at the 4.5% rate. So it will be based on the scheme's timeline, not their career timeline. So they would go straight in at that 4.5%. Something else to bear in mind is contributions are based on gross pay, so that'll include bonuses, overtime, but they will be deducted from net pay, so that's after tax. There is a cap as well, so if you do have any higher earners on the payroll, it is only earnings up to €80,000 that count. So if anyone earns more than that, then contributions will stop, and then they'll reset each year as well. So next thing I want to talk about is how NERSA actually assess an employee's earnings. So NERSA will use revenue payroll data to identify eligible employees. So they'll look back at 13 weeks to check the earnings, and if that look back period shows that the employee would earn over €20,000 annually, then they'll be auto-enrolled into the scheme, and they'll stay enrolled even if their earnings later drop. Now, the look-back period is just there because it ensures fair assessment and it prevents any short-term changes in pay from affecting someone's eligibility. And I did touch on this earlier, but one more point on this. So the look back does cover all employments, remember, not just yours. So any previous earnings as well with another employer will still count towards that threshold. Now, if an employee is auto-enrolled into My Future Fund, they are going to have some choices when it comes to auto-enrolment. Now, first, employees can opt out of the scheme, but this is only in months 7 and 8 after enrolment. So they do have to be in the scheme for a minimum of 6 months. If they do choose to opt out, it is their own contributions that will be refunded back to them. The employer contributions and the state contributions will remain invested into the pension pot. Now, second option employees have is they can choose to suspend their contributions for either 1 or 2 years. Now, during that suspension period, all contributions, so that's employee, employer and state, all contributions will stop. Now, with this option, there are no refunds and contributions can only restart after at least 1 year. So once they choose that option, that's the earliest they could then restart the contributions. Now, finally, if an employee does choose to opt out, they will be automatically re-enrolled after 2 years. But that is, of course, as long as they still meet the eligibility criteria. That just helps people from forgetting to actually rejoin the scheme. But if they still do want to opt out, they can, of course, opt out again through their online portal, and then you'll just receive an updated AEPN notice to then stop the contributions again. So they will go back in, but they can always opt out another time if they don't want to be in it still. So they've got a few options there, and that just gives employees a little bit flexibility when it comes to automatic enrolment. Now, I have mentioned the online portal a couple of times. So NERSA have launched a secure portal for My Future Fund, and that was launched on the 1st of December. Now, the portal is accessible to both employers and employees. Now, as an employer, what you need to do, so the action that you need to take, is you need to complete your profile and set up a direct debit just to ensure contributions transfer smoothly. Now, you'll log in using your existing ROS certificate details, and there are details on the website on how to complete registration. It should only take 5 minutes to do. I have included a link to the portal on the slide, so if you haven't already downloaded the handouts, make sure to get those downloaded. But if you haven't already set this up, you want to follow that link, get everything in place in good time for January. If you register and complete all of those steps early, it is really just going to help you stay compliant and avoid any penalties as well. So that's what you want to do from an employer side of things. Of course, employees can access the portal as well, and that's where they'll manage their enrolment. And they can access their account using their MyGov ID. And they'll be able to view balances, contributions, investment returns, and update their details or pause payments as well if they want to. So definitely get onto that and get that set up if you haven't already, so you've got it all in place in good time for January. So just to recap, remember, auto-enrolment is mandatory for eligible employees, and those are employees aged between 23 and 60, earning above €20,000 gross pay per year, and not currently in a pension scheme. Remember, there is that cap of €80,000 gross pay, and the contribution is calculated on gross and deducted from net. But remember, opt-out and suspension options are available for employees, but those are only in months 7 and 8.